We welcome our viewers to the New Year edition of Monthly Fixed Income Outlook. Welcome Kaustuv and a Happy New Year.
Thank you. Same to you. And Happy New Year to everyone.
Thank you. So Kaustuv, as we are in the year 2019 now, in a relatively more comfortable macroeconomic scenario, what should investors look out for in the year 2019?
So before we come to the 2019, we need to see the backdrop at which we have entered into 2019. 2018 was the year of two halves. In the first half, it was led by the strong global growth led by US. There were large amount of outflows from emerging markets. There were fears of inflation on account of higher commodity prices, and which led to hawkish central bankers at emerging markets. Suddenly, in the last 4 months of 2018, it looks like things changed completely U-turn. When the global growth started slowing down, inflation, which was largely driven by the energy prices and commodities, it starts slowing off, and which gives some space to emerging market central bankers to pause for some time. Now, as we enter in 2019, our view is that 2019 is the year of slow global growth, but better local growth in India. Inflation, which in 2019 was quite low on account of low food inflation, it should start reverting at mean levels, and we expect run rate to be more like 4.5 for 2019, and which make the case for central bankers to shift their stance to neutral levels, and most likely rates from here on will stay at a neutral biasness. The key uncertainties or risk, I would say, will come from political risk locally and from Europe, the Brexit, what's happening on that front, and what's happening on the US-China trade talks. So these are the key risks along with the energy prices which we are always exposed to for 2019.
So Kaustuv, in the last 2 months of 2018, sovereign bond yields have rallied down to around 750 levels now.
Yes.
How have our portfolios benefited from it, and what is the view on bond markets going forward?
Look, as discussed earlier also on this forum, that we went overweight on duration when the 10-year bond yields were around 8%. Now, as we speak, the 10-year yields are trading at around 7.45%. For next 3 months, at least in run-up to election, we see there is a big risk on account of possible fiscal stimulus in order to alleviate fiscal farm distress, and which opens up some kind of fiscal and inflationary risk. And resultantly, we have started reducing duration overweight positions across our portfolios. And from here on, we will be nimble-footed in all our portfolio positions, at least in run-up to the elections.
So Kaustuv, in this backdrop, how do the corporate bond markets look like? And do they still look attractive?
In current macro environment, one thing is quite clearly communicated by the RBI. That is, they are targeting liquidity, and they are doing all efforts to make sure that liquidity moves from deficit to neutral zone as soon as possible. Resultantly, they have announced large OMOs, and SLR curve has largely priced in the impact of these OMOs. As far as the non-SLR and AAA PSU corporate bonds are concerned, which is in the shorter end of the curve, which is 1 to 3 year, they clearly don't align with a new regime of neutral liquidity and lower inflation and lower growth levels, which is the current reality. And thus we think that these 1 to 3 year corporate bonds, they are quite adequately and attractively priced, and they are best accrual portfolios in current macroeconomic environment. And thus we suggest investors to come to these funds which invest predominantly in these 1 to 3 year AAA corporate bonds. And in our portfolios, I would like to suggest them Aditya Birla Sun Life Corporate Bond Fund and Aditya Birla Sun Life Banking and PSU funds. They are adequately placed to extract these opportunities for our investors.
So Kaustuv, other than the fund suggested by you, which should be so what is your view on the credit risk fund, which are also some accrual products which are investors are invested in?
In credit risk funds, even the credit spreads, they have gone up quite substantially over last 6 months. As the fiscal and monetary stimulus, which is currently underway, gets into the economy, it will be quite supportive of growth and balance sheet at micro level, and thus we think that even these spreads, they have quite a leeway to come off. And thus for the short term investors, I would suggest them they can continue to look at Aditya Birla Sun Life low duration funds, and from medium to long term perspective, they can continue to stick to our credit franchise, which is Aditya Birla Sun Life medium term plan and Aditya Birla Sun Life credit risk funds.
Thank you, Kaustuv, for your views.
Thank you.
Thank you, viewers, for listening to us. Till the next edition, see you. Bye-bye.
Thank you.